I thought what I might do today is just talk a little bit about our unique model because we're trying to bring out the best in financial services in Australia. Explain how our portfolio is constructed, our dual objectives, how we're seeing the market, and then a little bit about the social impact that we have. So maybe if I could go to my first slide or the next one. So Future Generation has been around now for 12 years. It was set up by Jeff Wilson, who runs and owns Wilson Asset Management. It was a model he'd seen overseas and brought it into Australia, and it's grown very significantly over the last 12 years. We now manage $1.3 billion on behalf of about 15,000 shareholders. And we run two investment products that are listed on the ASX. They're both listed investment companies. We have Future Generation Australia, which invests with Australian fund managers, and Future Generation Global, which invests with global fund managers. Now, our model is unique and we think brings out the best in Australian funds management. So what we do is we go to fund managers, we ask them to work for us for free. So they don't charge any performance fees or any management fees as they do normally to all of their clients. They work for us entirely free. We go to our service providers and we ask them also to work for free. And then we construct those fund managers into portfolios, as I said, Australian and global. And because those fund managers are working for us for free, and many of our service providers also working for free, we're able to donate 1% of our assets each year to some great not-for-profits that support particularly Aussie young people. So we've got two objectives. Our first objective, and it's our primary objective, is to deliver great risk-adjusted returns to our shareholders. And then our second objective is to support Aussie not-for-profits and have really significant social impact. Now, I'm very pleased to say that we've been able to donate over $100 million to not-for-profits in Australia so far over the last decade or more. But we also operate this fee advantage model. Because the fund managers and our service providers are working for free, we've been able to save $175 million in fees so far. And we've, as I said, donated $100 million to not-for-profits. So the difference between those two numbers, $75 million, that stays within the investment portfolios. That eventually ends up in the pockets of our shareholders. So rather than many funds management businesses which charge a fee, we're actually a fee advantage model and we're operating with purpose. Maybe if I could go to the next slide. So the way that we try and achieve our investment objective, which is to deliver great returns, but to manage risk, so to reduce the volatility in our portfolios, we do that through diversification. And the first layer of diversification that we offer is by fund manager. So we have 15 or 16 fund managers in each of the portfolios, as I said, all working for free, but they work in very different ways. So we have small cap managers, large cap managers, we have systematic and quantitative managers that are kind of hedge funds, so take long and short positions, and a broad range of strategies. They're all active managers, they're all boutique managers, but when we blend them together, that helps us to achieve that objective of having lower volatility, but great returns. And in the case of Future Generation Australia, for example, it's been able to stay ahead of the index since inception. So that's our first layer of diversification. If I can go to the next slide, I might explain why diversification we think is really important. Now, this is an example for the global market. So for Future Generation Global, I'll do the same for Future Generation Australia in a moment. But as you know, diversification is really the key way to ensure that you get the best out of risk and return in any portfolio. Now, that's always been the case, but at the moment, diversification is more important than ever because markets have become significantly more concentrated over the last decade or so. So the chart on the screen now shows the industry that has dominated, or the largest 10 companies in the world have been in over the last 100 years by decade. So to explain that a little bit further, in the 1930s and 40s, the global market, 4 of the 10 largest companies in those markets were industrial companies. They were companies like General Electric and Union Pacific. In the 60s and 70s, up to really 1980, the largest companies were dominated by consumer companies. Again, 4 of the top 10 companies were consumer companies. In that era, we saw the car companies in particular come to the fore, so Chrysler, General Motors, Ford, etc. In 1990, we saw in the run up to 1990, we saw Japan really explode. And it's hard to remember now, but in 1995, of the 10 largest companies in the world that were listed were Japanese banks. Of course, energy makes its appearance a couple of times over the last 100 years, obviously reacting to crises. So in 1950, it was after World War II and the rebuild and the growth around that. In 1990, it was obviously 1980 rather, it was the post-70s era, so post the Iranian Revolution, post the Suez Crisis, and obviously oil prices have spiked up again recently. So as you can see, historically, up to the year 2000, there's been significant change in the 10 companies that have made up the largest part of the index for the world. The industries have changed, the themes have changed, and there's been transition of those companies. Since 2000, it's really been all about technology. So technology is dominated for an unprecedented amount of time as a concentrated part of the MSCI, of the world market. But more recently, 8 of the 10 largest companies in the world are technology companies. What that means is the global market has become much more concentrated into a fewer companies. A large part of it is all dominated by one industry, so technology, and the themes associated with that. So the market's become concentrated, and that obviously elevates risk. So from our perspective, diversification is essential in making sure you spread those risks and ensure that you're not betting your entire portfolio on one theme. If I can go to the next slide, please. Now, as I mentioned, concentration in the index is not a new thing, but it's been around for a while, but it's actually increased very significantly over the last decade. So if you wind back 10 years, the biggest 10 companies in the MSCI made up about 10% of the index. Today, they make up close to a third. So those large companies have become larger. You may have read in the press recently that some of those large companies are now through the multi-trillion-dollar market cap level. So they're very, very big, very dominant companies. Obviously, they're in a sector which is dominated by AI, transforming the way that many businesses are likely to operate and many people are likely to work going forward. So a very powerful theme, but it is a single theme that's dominating world equity markets. Future Generation Global, which is our global listed investment company, as I mentioned, tries to seek lower volatility through diversification, and it's achieved that. The volatility in Future Generation has been significantly lower than the market over its life. The way we do that, diversification by manager. Now, we don't invest in stocks directly. We invest with fund managers who we think are the best in their part of the market. That diversification means that those fund managers, they're obviously making all of their own decisions through the different strategies that they employ. The result of that, when we look through those fund managers and see how they are invested, is that our portfolio is exposed to some of those 10 largest companies, and they're shown on the chart on the right. You'll have heard of Nvidia, Apple, Microsoft, Amazon, and so on. But our exposure is significantly less. So rather than it being close to a third of the value of the market, it's about 10% of the value of Future Generation Global. That enables us to spread the risks, spread the returns that we get in the portfolio, and diversify significantly more than many of the indices themselves. So one of the problems with market cap weighted indices, which is the MSCI, the S&P, the ASX, the FTSE, is that they tend to concentrate people's portfolios into those large companies. If you want to invest in a passive ETF or something that tracks an index, you are by default putting a large portion of your investment into those few companies because the way market cap indices work. So our view is the best way is to spread those out. If I can have the next slide, please. So we run a diversified global portfolio, as I mentioned, a broad range of strategies. And you can see from the pie chart on the left that at the moment, the largest portion of our strategies are in the absolute bias segment. So those are strategies that can they can hold more cash, they can take short positions. They're investing without reference to the benchmark, to the ASX or the MSCI. And we feel that's a sensible way to be invested because they're able to protect more on the downside should the market have a wobble. You can see from the table on the right that the world index is dominated by the US. It's close to 70% of the value of the MSCI, but we're less exposed to the US. In fact, our exposures are much more in medium and small size companies. Yes, invested in the US, but also in Europe, Japan, and elsewhere. If I could have the next slide, please. Thought it'd be worth just touching on the similar theme for Australia. So Australia's had a much more concentrated market for a longer period of time, particularly focused around mining and financials when you look back over long periods of time. At the moment in Australia, 5 of the 10 largest companies on the ASX are banks, so the big 4 retail banks and Macquarie, and they make up half of the value of the top 10. Again, because we have a diversification within the fund managers that we're using, our exposure to CBA, for example, which is close to 10% of the value of the ASX, is much lower. It's more like 3 or 4%. So we spread our bets much more significantly. Our exposure to the top 10 is more like 17% than close to half, which is what the top 10 makes up of the ASX. If I could have the next slide, please. Again, we have a bias towards the absolute type of strategies, so those which can hold more cash, take short positions, protect capital if the market has a difficult time. And our exposure is much more down the market cap spectrum. So outside of the top 50, we're much more overweight than within the top 50. And that's typically the area that fund managers find that they can add the most value. If I could have the next slide, please. Because we've got very stable investment portfolios through that diversification, it's not replicating the index, it's quite differentiated, but it is highly diversified. We're able to deliver fairly steady investment performance. And the purpose of that is to allow us to continually increase and produce steady income streams for our investors. Now, income's obviously very important at the moment, particularly with tax changes, which have been announced at the last budget. So the board's view for both of our investment companies is that dividends should be stable, we should be conservatively managing them, but we should be able to increase them steadily over time. The chart you can see now shows Future Generations' dividend profile. It's been increasing its dividends very regularly. Last year we paid, in addition to our increased fully franked normal dividends, we paid a 3-cent fully franked special dividend, and we've recently announced an increase in the interim dividend as well. So we're growing those dividends, generating what we think are attractive fully franked yields. So when you add in the value of franking, Future Generation Global is delivering a 7.1% dividend yield. We've got nearly 8 years worth of coverage on the balance sheet, so the dividend should be sustainable in the event of a market wobble. And we feel that's having visibility on dividends is very important for our shareholders. If I could have the next slide, please. It's the same story for Future Generation Australia, 10 years of growing dividends, 5.5 years worth of coverage, and an 8% yield when you add in the value of franking credits. So we think a significant and very important part of what we offer our shareholders is a growing income stream. If I could have the next slide. I'll just rattle through these, but we are a fairly high-profile organisation. We're very lucky to be supported by a lot of industry participants, and that's probably most notable in our boards and investment committees who help the governance and the portfolio construction for both of the companies. Future Generation Global is chaired by the former RBA Governor, Philip Lowe. If I can have the next slide. The investment committee is chaired by Jeff Wilson and is populated by a bunch of fund managers, institutional asset consultants, and people who have a great handle on markets and fund managers in Australia. Future Generation Global, which is the next slide, is chaired by Jennifer Westacott. She's on the next slide, if I could have that one. Jennifer Westacott, who is the former Chief Executive of the Business Council of Australia. She's Chancellor of the University of Western Sydney. And again, some other great independent directors. The next slide shows the investment committees. Fund managers, industry asset consultants who help us to bring together those fund managers. On the next slide, if I could have that, you can see how the impact that we have to meet our second objective, which is making a significant social impact, has been reached over many years. So more than $100 million donated to not-for-profits, and we'll be donating, I imagine, something like $13 million again this year. The next slide shows some of the not-for-profits that we support. Future Generation Australia is looking for organisations and supporting organisations that help vulnerable Aussie children. And Future Generation Global is helping mental health in young people and their well-being. We provide that funding to those organisations on an untied basis, so they get to deploy it how they think best to have the best impact they can. And we promise to give them that funding for multiple years, so they have some visibility on how that they can fund their great causes over long periods of time. If I can have the final slide. As I said, we have many people supporting Future Generation across both of our listed investment companies. One of those is CommSec, who I thought worth mentioning, allow people to buy into Future Generation without paying any brokerage. So they actually rebate brokerage if you decide to invest in Future Generation. So I said at the start, we're trying to bring together the best of financial services in Australia to deliver the best financial outcomes for our shareholders and for the society that we all live in. And we do that through some great fund managers, some pro bono boards and investment committees, and finding some fantastic not-for-profits that we support creating a social impact. So that's the end of my presentation. Happy to take any questions, Katie.
Fantastic. Thank you, Lee. So our first question is, what are the percentage fees charged for managing this portfolio and investor return pre and post fees?
So the beauty of Future Generation is we don't charge any fees. Everything is done on a pro bono basis. There's a very small, so no fees at all. The fund managers don't charge fees. Our investment committees don't charge fees. Our boards don't charge fees. Most of our service providers work absolutely for free. The work that goes on in the background is largely supported by Wilson Asset Management, who are our biggest supporter. Jeff, as I mentioned, set these things up. So no fees. There's a very small expense ratio for things that we can't for many reasons get pro bono, but it's a tiny amount, so no fees. In terms of returns, both companies have done relatively well over fairly long periods of time. Future Generation Australia is ahead of the market over 1 year, 3 years, and since inception. Future Generation Global is a bit behind the benchmark. That's largely because the MSCI's been dominated by a very small number of large cap tech companies. So we're a little bit behind the benchmark there, but for both companies, we've managed the volatility to be significantly lower than the market. So as I said, for Future Generation Australia, we've actually delivered better than market returns, but with a volatility which is something like 15% lower than that of the market and 30% lower than the small cap part of the market where we're largely invested. So some pretty solid returns, and we think well positioned through diversification to protect capital should we have a market correction at any point.
All right, next question. What is the biggest trade-off between delivering competitive shareholder returns, maintaining dividends, and continuing to grow the charitable contribution?
There are actually no. When I joined Future Generation about 18 months ago, I thought one of the main constraints that we'd face is finding fund managers that would work for us for free. I mean, we're in an industry which is essentially trying to make money the whole time. It's all about money. But actually, there's a very long list of fund managers who are waiting to work for us, who would like to work with Future Generation. We have benches of managers that we can introduce to our portfolios when we think it's appropriate. So that is one of the trade-offs that I'd imagine would be a problem, but hasn't been. In terms of the other trade-offs, within listed investment companies, we're always trying to make sure that we can maintain some capital growth and some income growth, sensible levels of income. That they are board decisions, but Future Generation, both of the Future Generation vehicles, as I said, have got a long track record of delivering growing income and pretty attractive income. As I said, sort of 7 or 8% tax-effective income for shareholders. So that is one of the trade-offs that we've made. Both companies have had really strong share price performance over the last year or so. Both have delivered total shareholder returns, including the value of the dividends and the associated franking, of more than 20%, which is pretty attractive given the Aussie market's been up 5 or 6% over the same period. So the way the model's set up, and because of the generosity of the fund managers and the service providers, there are very, very many fewer trade-offs within Future Generation than in a typical fund manager or listed investment company.
All right, next question. So you shared throughout your presentation that Future Gen has donated more than 100 million to Australian charities. How do you see the philanthropic side of the business evolving alongside the investment portfolio?
Yeah, that is an awesome question, and essentially we go through a process periodically. We've just done it recently for Future Generation Australia, where most of our partners had been funded for 10 years, and we went through a refresher. So let's make sure that where the money is going, that it has evolved to have the best possible impact. And we announced 11 new charities that we support 6 months or so ago. The way we think about that and the way we select the charities is we look for areas that we feel are either in dire need of some support or are lacking sufficient government spending. So in the case of Future Generation Global, the preventative measures of youth mental health, so supporting young people who are in the early stages of having mental health problems or in a tricky spot. So lots of mentoring programs and psychological support type programs. So we think very carefully. We have a very robust process about figuring out the exact parts of the market or parts of the economy, parts of the country, society that we want to support. And then we go through a very rigorous process of both selecting and monitoring the not-for-profits we support. So in the case of Future Generation Australia, as I mentioned, we refreshed those not-for-profits 6 months or so ago. We had 330, I think, applications for our funding for the next 5 years. And we whittled that down to 11. So the process is constantly evolving as the challenges to society are also evolving. And then we monitor all of those programs to make sure that the impact we're having is maximised.
All right, we have time for one more question. So, Leif, Future Generation aims to deliver both investment returns and meaningful social impact. What impact are you most proud of, and what has made it particularly significant?
I get asked that question occasionally, and I always avoid answering it because every time that we go and meet with one of our social impact partners, you see what they're doing. You see the children and young people who are benefiting from it. You hear stories of children who've come out of very difficult environments, homelessness, drugs, difficult sort of difficult sort of social environments which have led to mental health issues. There are so many children that have been helped by Future Generation. It's really impossible to say which one I'm most proud of, because it's always the last one that you hear about. You hear about a small child who's come out of an abusive home and has been put on the right track and is now at school and doing well and fully fed and dressed and so on. So I really couldn't single any one of them out. I think the thing that I'm probably most proud of is that as an industry, the Aussie funds management, in fact, we use some global fund managers as well from offshore, the funds management industry is so committed to giving back and supporting young Aussies. I think that's really something that I'm super proud of and constantly amazed at the generosity of the industry that we work in.
That's wonderful. Well, thank you so much for joining us, Lee. That's all we've got time for in this section. Thank you very much for joining us and the Future Generation team.
Thanks for having us, Katie.